What is happening, crypto fam? Get ready, because the news cycle is absolutely exploding, and you are not going to want to miss a single second of what's dropping today. We've got seismic shifts in the market, big money making bold moves, and regulatory whispers that could change everything. From Wall Street titans seeing massive upside to groundbreaking tech upgrades, this is the briefing that keeps you ahead of the curve. Buckle up, because the future of finance is unfolding right now, and we're diving deep into the stories that matter most. Let's get into it. First up, we're talking about the big players. Wall Street giants are doubling down on digital assets, with one major bank making a bold claim that Bitcoin is significantly undervalued compared to gold. This isn't just a casual observation. It's backed by data showing falling volatility and a potential price target that'll blow your mind. Plus, we're seeing massive institutional investment pouring into Ethereum products, signaling a major shift in how the big money views the crypto landscape. Then, we're keeping a close eye on the regulatory front. With a major economic leadership position up for grabs, the candidates being considered have some seriously interesting takes on cryptocurrency. We're talking about potential Fed chairs who aren't just open to digital assets, but are actively exploring their potential impact on the financial system. This could set the stage for the future of market regulation, and you need to know who's in the running and what they believe. And finally, we're hitting the innovation highway. One of the most talked about blockchains is rolling out a massive upgrade designed to make transactions lightning fast, almost instantaneous. This could fundamentally change the user experience and open up a whole new world of possibilities. Don't go anywhere. We've got all the details and what it means for you. Hit that like button, subscribe, and ring that notification bell so you never miss an update. Wall Street's bold bet, Bitcoin undervalued against gold. Get ready for a major shakeup in how traditional finance views digital assets. A prominent Wall Street institution has just released a report that could fundamentally alter the perception of Bitcoin's value, arguing that the flagship cryptocurrency is significantly undervalued when compared to gold. This isn't just idle speculation. The analysis is grounded in observable market trends, particularly the dramatic decrease in Bitcoin's volatility. In fact, the report highlights that Bitcoin's 6-month volatility has plummeted from nearly 60% at the beginning of the year to an all-time low of approximately 30%. This stabilization is crucial because it makes Bitcoin a more palatable asset for institutional investors who have historically shied away from its perceived wild price swings. The implications of this reduced volatility are substantial. Analysts connected to the report suggest that, on a volatility-adjusted basis, Bitcoin's price should actually be around 13% higher, reaching approximately $126,000, to be on par with gold's private investment market capitalization. This narrative is being fueled by an acceleration in purchases from corporate treasuries, which are increasingly allocating portions of their reserves to Bitcoin. This trend is not only making the asset more attractive for traditional institutional portfolios, but also signals a growing acceptance and integration of Bitcoin into mainstream corporate finance strategies. The report's findings suggest a potential paradigm shift, where Bitcoin is no longer seen as a speculative fringe asset, but as a legitimate store of value and a potential hedge against inflation, much like gold has been for centuries. Adding fuel to this evolving narrative is the continued aggressive accumulation of Ether-related assets by prominent investment firms. Notably, Cathie Wood's ARK Invest has once again made a significant purchase, acquiring an additional $15.6 million worth of shares in Bitmine Immersion Technologies, a company often viewed as an Ether proxy. These shares were strategically added to ARK's flagship ETFs, including the Innovation, Next Generation Internet, and FinTech Innovation ETFs. This latest acquisition pushes ARK's total holdings in Bitmine to over $300 million, placing it as a substantial position, nearly half the size of its investment in Coinbase. This consistent investment by a high-profile fund manager like Cathie Wood underscores a strong conviction in the growth potential of Ether and its associated ecosystem, further bolstering the institutional interest in digital assets. Furthermore, the data on exchange-traded funds, ETFs, paints a compelling picture of investor preference. Spot Ether ETFs have been experiencing an unprecedented surge in demand, attracting over $1.83 billion in inflows within the last 5 trading days alone. This figure is more than 10 times the inflows seen by their Bitcoin counterparts during the same period. This remarkable trend is occurring in the wake of new stablecoin legislation, a development that significantly benefits the Ethereum network, given its dominant market share in stablecoins and tokenized assets. The implications are profound, with industry leaders like Van Eck CEO Jan Van Eck openly referring to Ether as the Wall Street token, emphasizing that traditional financial institutions must embrace the Ethereum blockchain for stablecoin transfers to remain competitive. Bloomberg ETF analyst James Seyffart has also noted that investment advisors are emerging as the top holders of these Ether ETFs, with major players like Goldman Sachs leading the pack with substantial exposure, indicating a broad-based institutional adoption of Ether-based investment products. But the institutional embrace doesn't stop at investment vehicles. It's also influencing potential regulatory leadership. Could the next Federal Reserve chair champion a crypto-friendly future? The community is buzzing about these developments, with many seeing it as validation of Bitcoin's long-term potential and a sign that institutional adoption is accelerating rapidly. Analysts are closely watching how these large-scale investments will impact market stability and price discovery, while smaller investors are inspired by the growing legitimacy of the asset class. Now, hold on tight, because the regulatory landscape is about to get even more interesting as we look at who might be steering the ship at the Federal Reserve. And that leads us directly into our next major story: the potential impact of the next Federal Reserve chair on the crypto world. Bitcoin funds hit $162 billion AUM, the new gold standard. In a development that could redefine the concept of safe haven assets, Bitcoin-focused investment funds have experienced a monumental surge, reaching an astonishing $162 billion in assets under management, AUM, by 2025. This dramatic increase signals a profound shift in investor sentiment and portfolio allocation, with many beginning to question whether Bitcoin is poised to dethrone traditional safe havens like gold. The sheer volume of capital flowing into these funds indicates a growing conviction among a diverse range of investors, from retail participants to sophisticated institutional players, that Bitcoin represents a robust hedge against economic uncertainty and inflation. This growing AUM is not merely a statistical anomaly. It reflects a broader narrative of Bitcoin's increasing acceptance as a legitimate store of value in the modern financial ecosystem. The surge in AUM is largely attributable to several key factors, including the advent of spot Bitcoin ETFs in major markets, which have democratized access to the cryptocurrency for a wider investor base. These ETFs have lowered the barrier to entry, allowing individuals and institutions to gain exposure to Bitcoin through familiar brokerage accounts without the complexities of direct digital asset custody. Furthermore, the ongoing macroeconomic climate, characterized by persistent inflation concerns and geopolitical instability, has amplified the appeal of Bitcoin as an inflation hedge. Its decentralized nature and fixed supply cap of 21 million coins provide a compelling counterpoint to fiat currencies, which can be subject to inflationary pressures and government policy decisions. This inherent scarcity and resistance to censorship are increasingly being recognized as valuable attributes in an unpredictable global economic environment. The narrative of Bitcoin as a digital gold is gaining significant traction, not just among crypto enthusiasts, but also among traditional financial analysts and economists. They point to Bitcoin's increasing correlation with gold during periods of market stress and its consistent performance in preserving purchasing power over the long term. While gold has historically been the go-to asset for wealth preservation, Bitcoin's digital native characteristics, such as its divisibility, portability, and ability to be transacted globally with relative ease, offer a unique value proposition. The infrastructure supporting Bitcoin, including institutional-grade custody solutions and regulated financial products, has matured significantly, further bolstering investor confidence. This maturation process is critical in bridging the gap between the traditional financial world and the burgeoning digital asset space, making Bitcoin a more compelling alternative to established safe havens. Moreover, the increasing adoption of Bitcoin by corporations and its integration into mainstream financial services further solidify its position. Companies holding Bitcoin on their balance sheets, alongside the growing number of financial institutions offering Bitcoin-related products and services, contribute to its legitimacy and perceived stability. This institutional embrace is a powerful signal to the broader market, encouraging more cautious investors to consider Bitcoin as a component of a diversified investment strategy. The continued development of the Bitcoin ecosystem, including advancements in scalability and transaction efficiency, also plays a crucial role in its long-term viability and attractiveness as a global reserve asset. As more capital flows into Bitcoin funds, the network's security and decentralization are further enhanced, creating a positive feedback loop that reinforces its status as a reliable store of value. This growing institutional confidence is creating ripples across the entire digital asset market, with other cryptocurrencies also seeing increased attention. But what does this mean for the future of investment, and can Bitcoin truly eclipse its precious metal predecessor? The sheer scale of these inflows is unprecedented and points towards a fundamental reevaluation of Bitcoin's role in global finance. Investors are clearly seeking assets that offer protection against inflation and economic volatility, and Bitcoin is increasingly fitting that bill. Now, while Bitcoin is making waves as a potential safe haven, the spotlight is also turning towards its blockchain counterpart, Ethereum, and its surprising performance in the ETF market. And that brings us to our next critical update on why Ether ETFs are outperforming their Bitcoin cousins. Ether ETFs outshine Bitcoin in investor frenzy. The Wall Street token ascends. In a stunning turn of events that has captured the attention of the financial world, Ether exchange-traded funds, ETFs, are experiencing an investor adoption rate that dramatically eclipses that of their Bitcoin counterparts. Recent data reveals that spot Ether ETFs have attracted over $1.83 billion in inflows within a mere 5 trading days, a staggering figure that is more than 10 times the inflows seen by Bitcoin ETFs during the same period. This surge in demand is not occurring in a vacuum. It follows closely on the heels of significant legislative developments concerning stablecoins. Given that the Ethereum network commands the largest market share for stablecoins and a vast array of tokenized assets, these regulatory advancements have positioned Ether as a prime beneficiary, fueling a wave of institutional and retail interest. The implications of this trend are profound, leading prominent figures in the financial industry to reevaluate Ether's position in the market. Jan van Eck, the CEO of investment management firm Van Eck, recently articulated this sentiment in an interview with Fox Business, boldly declaring Ether as the Wall Street token. He argued that traditional financial institutions are facing a critical juncture. They must embrace the underlying blockchain technology, particularly for managing stablecoin transfers and other digital asset transactions, or risk being left behind in an increasingly digitized financial landscape. This assertion highlights a growing consensus that Ethereum's robust ecosystem, its smart contract capabilities, and its foundational role in the burgeoning world of decentralized finance, DeFi and tokenization make it an indispensable component of future financial infrastructure. The momentum behind Ether ETFs is further amplified by insights from industry analysts and regulatory filings. Bloomberg ETF analyst James Seifert reported that investment advisors have emerged as the leading holders of these Ether ETFs. According to SEC filings, major financial institutions like Goldman Sachs are at the forefront, demonstrating substantial exposure, with holdings reportedly reaching $712 million. This indicates that the primary drivers of Ether ETF inflows are not speculative retail traders, but rather established financial intermediaries integrating Ether into their investment strategies and client portfolios. This institutional adoption is a critical validation of Ether's potential as a legitimate investment asset, moving beyond its perception as solely a utility token for the Ethereum network. This surge in interest can also be attributed to the expanding use cases for Ether and the Ethereum network. As a platform for decentralized applications, dApps, smart contracts, and the rapidly growing DeFi sector, Ethereum offers a rich technological foundation. The network's ability to facilitate complex financial transactions, manage digital identities, and power a vast ecosystem of innovative projects makes it highly attractive to investors looking for exposure to the next wave of technological innovation. Furthermore, the upcoming halving events for other cryptocurrencies and the ongoing debate about Bitcoin's inflation hedge capabilities often bring Ether's utility and deflationary mechanisms, such as token burning, into sharper focus. The increasing clarity around the regulatory treatment of digital assets, particularly stablecoins, is also removing a layer of uncertainty that previously hampered institutional investment in the space. These developments clearly show a maturing digital asset market, with investors actively seeking diverse opportunities beyond just Bitcoin. But are these Ether ETF inflows a sign of a long-term shift, or a temporary trend driven by specific market conditions? The market is clearly signaling a strong preference for Ether-based investment products right now, driven by its utility and the broader ecosystem growth. This outperformance is a testament to Ethereum's foundational role in the digital economy. Now, while the established giants are making their moves, the decentralized finance world is buzzing with a different kind of innovation, one that could fundamentally change how Bitcoin interacts with DeFi. And that leads us straight into our next story about a significant funding round that's putting Bitcoin at the center of cross-chain trading. Portal's $50 million boost. Bitcoin's DeFi revolution ignites cross-chain trading. Bitcoin's presence in the decentralized finance, DeFi landscape is poised for a dramatic expansion, thanks to a substantial $50 million funding injection into Portal, a platform focused on enabling secure cross-chain trading. This significant capital infusion not only marks a major win for Portal, but also serves as a powerful testament to increasing institutional recognition of Bitcoin as a pivotal player in the DeFi space. The funding is earmarked to accelerate the development of cross-chain trading capabilities, crucially integrating the inherent security and robustness that Bitcoin provides. This initiative extends beyond Bitcoin itself, aiming to seamlessly connect with other major blockchains, such as Ethereum and Solana, thereby positioning Bitcoin as a central linchpin in the broader DeFi ecosystem. Portal's core mission is to bring sophisticated cross-chain trading functionalities directly to the Bitcoin network, establishing a solid framework that facilitates smooth and secure trading interactions across diverse blockchain ecosystems. The founders envision a future where Bitcoin is not merely a store of value, but an active participant in the dynamic world of DeFi, enabling users to leverage their Bitcoin holdings within a variety of decentralized applications. This strategic move is particularly timely, as institutional investors are actively seeking Bitcoin-native DeFi options. The influx of capital into projects like Portal could lead to a significant increase in Bitcoin's total value locked, TVL, across DeFi applications, injecting much-needed liquidity and fostering greater interoperability between different blockchain networks, including Ethereum and Solana. This symbiotic relationship could further solidify Bitcoin's standing and utility within the rapidly evolving DeFi sector. Historical precedents in the crypto market suggest that funding rounds of this magnitude often precede significant liquidity booms. Examples like Thorchain and RenVM, which saw substantial funding, subsequently experienced notable liquidity spikes and contributed to a generally positive market sentiment. Portal's funding could trigger similar effects, boosting activity and TVL for Bitcoin and its associated blockchain ecosystems. Reflecting on past funding cycles, such as the 2016-2017 ICO boom, highlights the potential for liquidity gains, though it also underscores the importance of regulatory clarity, as subsequent crackdowns led to market downturns. This serves as a reminder that liquidity trends can be influenced by external factors, making regulatory developments a key consideration. The crypto industry is also witnessing a broader trend away from purely speculative tokens towards projects with sustainable business models. A significant majority of funded crypto projects are now tokenless, a shift that has coincided with an uptick in liquidity. This suggests a maturing venture capital landscape, often termed liquidity VC, which prioritizes projects with tangible utility and long-term viability, offering better liquidity and more predictable exit opportunities. As Bitcoin's role in DeFi continues to evolve, institutional investments and technological advancements are paramount. The development of Bitcoin-native Layer 2 networks and smart contract platforms is making Bitcoin more programmable, enabling DeFi applications to operate directly on or around its base layer. This opens the door for Bitcoin to be utilized in decentralized lending, staking, and derivatives markets, transcending its traditional role as merely a store of value. Looking ahead, regulatory clarity is anticipated to reduce market uncertainty, potentially encouraging greater institutional participation in Bitcoin-related DeFi platforms. The interoperability between blockchains and the expansion of decentralized derivatives markets will also be crucial for enhancing Bitcoin's utility and influence in DeFi. Portal's $50 million funding represents a pivotal moment, amplifying Bitcoin's integration into decentralized finance by fostering institutional interest and unlocking new avenues for liquidity and market activity. By learning from past market cycles and embracing new technologies, Bitcoin is strategically positioned to become a more active, yield-generating asset within the global financial ecosystem. This funding round is a clear indicator of how interconnected the crypto world is becoming, with major blockchains learning from each other. But what does this mean for the average user, and how will this impact the broader DeFi ecosystem? This investment is a game changer for Bitcoin in DeFi, signaling that institutions are betting on its integration into multi-chain strategies. It's all about unlocking new liquidity and utility for the king of crypto. And that brings us to the end of our deep dives today. We've covered the big banks, the potential Fed chairs, the Ether ETF surge, and now Bitcoin's DeFi leap. But before you go, let's do a quick recap. And that's a wrap on today's essential crypto updates. We saw JPMorgan calling Bitcoin undervalued against gold, Ether ETFs absolutely crushing Bitcoin inflows, a major boost for Bitcoin and DeFi with Portal's massive funding, and a look at crypto-friendly candidates for the Fed chair. Don't miss out on any of the action. Make sure you're subscribed, hit that notification bell, smash that like button, and follow us on all our social channels for even more real-time updates. We'll see you tomorrow.